Hey folks, welcome back to episode 13, ICT's 2024 Mentorship. The same way I have explained the all other episodes, I'm gonna express my understanding about this specific video as well. Don't forget to give me the thumbs up and subscribe to my channel if you are new, and if you think it's informational and it's helping you, I'll be very glad to hear about that. Okay. And if you think no, it's not good and I have to update some things or I have to add something, I have to remove something, let me know that in the comment box. Don't forget to give me the feedback. That's my request to all of you. Please don't forget to give me the feedback. If it is good, good. If it is bad, then bad. Just give me the feedback. So over here, this is the Tuesday price action, and you can see this is the Monday 4:59 closing, 6 opening. This is the new day opening gap. You have to mark this new day opening gap. Above here, this is that volume imbalance from daily chart. If you go to your daily chart, you will see this volume imbalance. And if you have already watched my previous episode, you already know where this volume balance is from. So all you can see that market actually traded this new day opening gap on time. First, it has traded the low of that volume balance, tick by tick. Okay, then look at the reaction from the new day opening gap around that area. How beautiful the reaction was over there. All of those are the relatively equal lows. Market went lower, took all of these relatively equal lows, and also these relatively equal lows, this low and that low. They were the relatively equal lows. Market has taken that relatively equal lows, went through this new day opening gap, then traded higher until the 50% of that volume imbalance, tick by tick. You don't need anything else except this precision. Okay, then market was trading the whole time. Market was trading around the lower part of this volume imbalance, went higher, closed around the upper quadrant. How beautifully it has closed over there. Come back again, trade this new day opening gap. Body didn't close below this new day opening gap. Just if you see over here, take a closer look. Look how beautifully the body was respected around that area. See, no body did it closed below this new day opening gap. What else do you see? Remember, when market has taken this liquidity relatively equal lows, it left that buy side imbalance, sell side inefficiency over there. So market has traded that buy side imbalance, sell side inefficiency around that area. This area has been traded over there. So it has balanced this area by going up and down here. It has balanced this one. After balancing this one, market went higher, trade the lower quadrant. Look at the reaction from that lower quadrant, and then market is reaching around that area. This is the 8:30. I mean, sorry, 9:30. I would love to talk about the price action from this 9:30, as ICT has actually explained the price action from 9:30. So I would love to go to the regular trading hour first. To just let me come here, okay, and let me actually close every other price. So until this area, ICT has actually explained the price action. So around 9:30, first what you have to do, you have to mark the closing. Here is my closing of you can see that 4:15, that is the closing, and the opening around 9:30. Okay, this is my opening gap. Remember, this is my opening gap, that yellow box. You have to mark it from your regular trading hour, and as you can see here, market opened, then went higher. Now you know that market is reaching for this volume imbalance. Why market is reaching for that volume imbalance? If you go to your chart, actually I forgot to show you something. Around there, this portion is still open from that volume imbalance. Market didn't trade that portion. Okay, so until that area, this portion is untraded. You remember, it has traded the upper quadrant. I have shown you that it has traded the upper quadrant of the volume balance. If you don't remember, just go little before, I mean, rewind the video, and you will see that first it has traded the 50% of that volume balance, then it has traded the upper quadrant. It didn't close this volume balance perfectly, 100% fully. No, it didn't close it. So ICT's expectation was market will go toward that unfilled area. Market will reach for that unfilled area. So he was looking for a buy. He marked this opening gap. That means previous day close and today's 9:30 open. There is a gap. As per ICT, if market closed below, okay, here is the closing, it opened over there. If it opened lower, then from there to the 50%, it's a trade. Don't just go to your chart and don't push your button. Most of the time you will see that if market close over there, and open much lower, then at least it will reach for this 50%, and ultimately this is also a trade. Yeah, it can go little lower first, little lower, then it will at least go until that 50% or maximum the upper quadrant, or it will fill this fair value gap before opening gap before falling. If you are looking for sell, then from here to the 50%, this is a single concept to trade. If you can take it continuously by observing this market, you are done. You don't need to do anything else. Now, for example, you are looking for upper run, as ICT was looking for this volume space, that unfilled space. Market will go for that unfilled space and it will actually close over there. So he was actually bullish. He was expecting that market will close above this opening gap. As you can see, market has closed above this opening gap and the new day opening gap. So this is the new day opening gap. Market has closed above the new day opening gap. Trade the volume imbalance. So over here, not the volume imbalance, sorry, the opening gap. Used that opening gap as a support. Look at the bodies. Nobody has closed. Not even a single body has closed below or inside this opening gap. It has used that opening gap high as a support, then went through this new day opening gap one more time, used this new day opening gap as a support. When you see this, and there is market went higher, it went higher, there is a fair value gap over there. Okay, so let me mark that fair value gap, that area. This is your fair value gap. Market has traded that fair value gap. ICT expected that this fair value gap is going to be open. Okay, there is little portion of this fair value gap will be open until the lower quadrant, 50%, upper quadrant, and finally this volume balance. You are not going to hold your trade for that volume balance. The lower quadrant, take the partial. 50%, take the partial. Try to hold your trade until the upper quadrant, take the partial. And finally, you see that it can reach over there to that specific area which is still unfilled. It can reach over there or not. Okay. Now, when he was expecting this is going to be unfilled, if it fills this fair value gap, how far it can reach? Look at here, this week. Okay, this week is a single swing high. Mark the 50% of that specific week. See this 50%? Price came here, used that 50% as a support. So market has closed this fair value gap just to trade the 50% of that week. Okay, he doesn't want to see body will close below this 50%. It can reach until this area. So sometimes when ICT actually put his stop loss and he just told that I would love to see this is going to be unfilled, but he actually covered the 50% of that specific week, because he knows if it doesn't fill, if it fills this fair value gap, this week is the last line market can reach. So your stop loss is safe just 1 or 2 tick below of this constant constant of that specific week, if you know where market is reaching for. Okay, then market actually came here and failed to trade this one, but unfortunately, identically this is your trade from that gap high to the 50%. Take the partial, you are done. Then get stopped out to the break even, you are done. You don't need to worry. If you know this thing closed there, open lower, so you know that market will reach at least until the 50%. Don't just go to your chart and push your button. Don't do that. Observe these things again and again, how it is going over there. Even if it would love to fall, if market would love to go higher, there is nothing wrong, because market is going to close this opening gap. But even if market would love to fall, it most of the time it trade the 50% of that opening gap. Okay, so the opening gap you will get from here, electronic trading hour, regular trading hour. If you go to your regular trading hour, you will get that opening gap around 9:30. So either way, this is a setup. This is also a setup. If you can catch any of them, you are profitable. Then what market came? Where did it came again? See this fair value gap, it came over there. Trade that sell side imbalance, buy side inefficiency. After trading that area, it broke. How beautifully it has broken. Look how beautifully it has broken. And then finally took this low, and there was the imbalance that can be triggered, and then later the other price action you can see. But ICT's expectation was market will go over there. He doesn't need to catch the top. He doesn't need to do that. He will get this opportunity to take the buy from there. He know that my stop loss is safe below this 50% of that week. He will put his stop loss over there. He will take a portion here to the lower quadrant to the 50%. Then he will try to hold it if it can reach over there or not. If it failed to reach over there, maybe he will trail his stop loss and he will be stopped out around any time or anywhere over there. So far we have learned that if you have the newly opening gap and you have the opening gap and your bias is bullish, first you will expect that market will go through this opening gap. Yeah, obviously it can go a little lower first to trade some kind of imbalance, any kind of imbalance, or to take some kind of liquidity. It can do that. It doesn't need to open and keep going higher. It doesn't need to do that. It can go a little lower. Then it will go through this opening gap. If it can go through this opening gap, then you will expect that market will use this opening gap as a support. It doesn't need to trade make it support the high of that opening gap. It can reach until the upper quadrant 50% or the lower quadrant. It can reach any of these three levels. If it can use any of that as a support, and then there is the, as you can see, there is a new opening gap. It went through this new opening gap. After using this opening gap as a support, if it can go through this new opening gap one more time, then it will use this new opening gap as a support. So first opening gap support, then new opening gap support, then there is a parallel gap. From 1 minute chart, see this market structure shift. This is the market structure shift. 1 minute fair value gap over there. Trade that 1 minute fair value gap. How far it can reach? Until the 50% of that specific week. After trading that, boom, market reached until a certain level. So that is the theme I got from ICT episode 30. So if you use this information by using opening gap, I hope that you will be you will do better. You will do great. Okay. So make sure that if it is understandable or not. If you have still any doubts, let me know in the comment box. So until the next video, cheers.